How do you know if a property is worth investing in? How can you ensure that you'll get a good return on your investment? What is up, everyone? If you're just like me and are looking to invest in property, but are also looking for effective ways to evaluate a given investment property, then this video is for you. The property analysis tools in this video, from cash flow analysis to rental income projections, are used by pros. So as beginners or just first-time homebuyers, these will no doubt help you make smart and informed data-driven decisions. Hopefully, by the end of this video, you'll have a better understanding of the knowledge needed to evaluate the market value of a property and the benefits that you can derive from purchasing it, such as rental income and the overall return on your investment. As a real estate investor or someone who is looking to get into real estate, one of the most important factors to consider is how much income a potential property can generate. The gross rent multiplier, or the GRM, is a simple calculation that can help you estimate the property's earnings potential. It's calculated by dividing the sales price of the property by the annual rental income. For example, let's say you are looking to buy a piece of property for $400,000 and you expect that property to generate $20,000 annually. To calculate the GRM, you will need to divide the $400,000 sale price of the house by $20,000. So in this scenario, the GRM would be 20. Now, to get the annual rental income of a property, the divisor, the number under the line in the division equation, you will need to determine the monthly rental rate. To do this, you'll need to research similar properties in the area or your local market and see what other homes are renting for. Now, what does the GRM exactly mean and how does it help? Basically, the GRM provides an estimate of how long it would take you to recover the initial price of the investment. And this is based on the rental income. For this example, we have the sales price of $400,000 and the annual rental income of $20,000. So it will take us 20 years to recoup our initial investment. And that's just assuming there are no other expenses. So basically what this says is the lower the gross rent multiplier, the GRM, the better value. And this is because relative to the price of the property, a lower GRM indicates that it is generating more income. Generally, you want a GRM of about 10 and lower. Some would say 7 and lower. So the 20 in this scenario would not be ideal. So if you can find a property within the gross rent multiplier of 1 to 10 in this scenario, as an example, you should probably check out the property and go speak to the seller. A tip here, you can always negotiate the sales price of a home with the seller so that you can bring the GRM down. Now, while the gross rent multiplier is a good and simple tool for evaluating property, it does not take into account all of the expenses that are associated with owning property. Managing a property usually always comes with your typical expenses like property tax, insurance, utilities, etc. So for a more complete evaluation, real estate investors will always turn to the capitalization rate, also known as the cap rate. The capitalization rate also measures the potential rate of return on a piece of property based on the net operating income and the market value of the property. The equation for the cap rate is calculated by taking the NOI by its market value, the divisor in the scenario, that's the market value of the property. To get the net operating income, we need to take the annual rental income minus all of the expenses associated with owning that home or that piece of property. For example, in our last equation, the annual rental income was $20,000, and say on top of that, we had yearly property taxes totaling $1,000, insurance of $500, and utilities for another $500. This will give us a net operating income of $18,000. That's $20,000 minus the $2,000 worth of expenses. Now, with the market value of the home of $400,000, we will divide the NOI of $18,000 by its market value of $400,000 to arrive at a cap rate of 4.5%, which means that the given property is expected to generate a 4.5 annual return on investment. The higher the number, the more attractive. And that's because a higher cap rate will suggest a higher rate of return on investment. And this is really useful, especially when you're trying to compare properties that are of similar nature. And if you want to figure out what the potential expenses for similar homes are, you can always talk to a property manager in the area and see what they're paying for expenses. Now, it's important that you understand this calculation is based on buying a $400,000 piece of property with cash. If you take out a loan, you will need to take the total interest payments into account. Lastly, it's important that you consider all of the factors, the term of the deal, what's the current interest rate, what are the current economic conditions, the market conditions, whether it's a buyer's market or a seller's market. For example, say if it's a buyer's market, you'll most likely be able to negotiate much easier, even though you can always negotiate. Additionally, there are other metrics you should use instead of just relying on just one. That wouldn't be very smart. For example, you can also analyze the property using the cash on cash method. So the more information and knowledge that you take in will help you shift opportunities and favor on your side. And if you made it to the end of this video, thank you. I leave you with this timeless saying, buy real estate. After all, they're not making more of it. Hit that subscribe button for me, and I'll see you guys on the next one.